It was a lot easier to get a higher leverage, lower rate loan. And now it's not as simple. Survive to 2025. That is the hashtag of the next year or so because things have changed so much.
The age of easy money was a great one. Starting in 2008, the Federal Reserve kept interest rates incredibly low to stimulate the economy. In 2022, the tides changed, and this age of easy money was over. To break down what this means for real estate investors, we brought on mortgage broker and financing expert Brandi Shotwell. Changing interest rates are nothing new, but we've experienced the fastest rate of change in decades. But, as you're about to find out, there is hope. I was at an event last month, and I met a newer mortgage broker there. And he said all mortgage brokers are the same and offer the same service. So it really does come down to who you're working with and whether or not you like them. But the first thought I had was Brandy, and I thought there must be more to that than what he said. So can you
Yes.
first off just tell us and explain what a mortgage broker does? Let me know. Do you agree with that, or if not, how does a mortgage broker stand out among the rest?
A mortgage broker is a broker, a person that acts as a middleman between the lender and the borrower. So when you're working with a mortgage broker, they're going to go out and they're going to shop your deal to different lenders to try to find you the best terms, the best leverage, the best rate for your specific deal. The benefit of working with a broker is that you get access to a lot of different options, right? Versus you working with one particular bank or one particular lender, where if you're working on a property or you're working on a deal, that has to fit into their program. And if it doesn't, maybe you won't get the best terms, or maybe they won't be able to finance it at all. And so having a broker on your team is invaluable. The information that they can provide to you and the resources that they should have. One thing I can say is that the commercial real estate industry, I've been on both sides. I've been on single family, I've been on multifamily, I've always been a broker. But one thing I can say that is different about the commercial real estate world is that we do all kind of pull from the same lenders. The difference is going to be your broker's relationship with that lender, right? And the difference is going to be the support that you receive from that broker throughout the process. So there are some brokers who are lazier, less responsive than others, right? And there are others that are, hey, I'm going to respond to you right away. I'm going to go out to multiple lenders that I have good relationships with that would be able to help you with this deal, especially if it's a tough deal. And more importantly, more than anything, is having that broker that is not just in it for the deal. I spend a huge amount of my day now, especially in this climate, helping on deals that I closed in the past. And so I don't think a lot of brokers can say that. Usually you don't see them after, unless you do have that relationship with them. So them being able to support you and work with you and the lender even after closing is invaluable because you're going to run into issues when you own a property and you're being serviced by that lender. You may run into, I don't even want to say may, you're going to have issues that you run into that you may need help with. So having that broker is invaluable, but there is definitely a difference between brokers. They're not all the same.
Yeah, I'm glad you emphasized that distinction. So essentially, you mentioned this, but as a mortgage broker, you're the bridge between the lender and the investor in their deals. I wanted to know, because I'm just honestly curious, like how do you even find lenders to build relationships with, and how do you nurture those relationships?
Yeah, so it's hard to say when I've been in the industry for so long, but usually when if you are in the mortgage industry and you join a firm that is a bankerage brokerage firm, they're going to have those relationships set up. You're going to establish your own relationships with those reps at those lenders, at those particular lenders. And then it's just a matter of talking to your lenders on a daily basis. My lenders will fly in to see me. If I'm in their area, I'm going to go see them. We're going to have lunch. We're going to talk, and we're going to meet at industry specific conferences, and we're going to talk. Then, I can tell you my like top 15, 20 lenders. I know if they're married, how many kids they have, what school they went to, what are their likes and dislikes, because we're always keeping in touch with one another. So it's beyond just the business, just as if I would do with my clients, just having that strong relationship with my clients, knowing about them personally. And that's how you build that relationship, just like you would any other, just making sure that you're keeping in contact with those people and, being actually genuinely concerned about what's going on in their world.
100%. That reminds me of something that, like, I know we run in similar circles in terms of like investments and the groups that we're a part of. And I know like a theme that I've always heard is you do business with people you like, and you actually are friends with the people you do business with. And so that seems like it's a prevalent theme in your space as well. That's awesome.
Yeah, absolutely. Absolutely. 100%. And so having that relationship with the lender to me is just as important as, having that relationship with my client.
Yeah, and it's clear to me that like having a mortgage broker is an essential team member, especially right now in this environment that we're seeing. And in light of the changes that we've recently seen in the economy and in the real estate sector, I wanted to have you maybe provide some context. What changes have you seen in recent months, specifically in the real estate financing space?
So the first thing I would say is volume is a lot lower than what it has been the last 3 years. The second thing is obviously the rates. Rates are higher, LTVs are lower, and I'm seeing a lot of lenders ask a lot of questions on deals. It's like getting a deal done now is not as easy as it was the last few years, because I swear we're answering so many questions. They're digging in a lot more than what they were before. I mean, they dug in before, but this is like next level. I'm like, gosh, I even missed that. Like, why are you asking this? So it's just a lot more when I mean, I've been through several, ups and downs in the real estate market like we all have over the last, 20 some odd years. So it's cyclical. So when we see, the rates trending up, I mean, the rates went up, what, 500 basis points in the last year in terms of the Fed rate. So when we see what's happening in this economic climate, you're going to see credit tightening, and you're going to see, you're going to be getting pushback, and things won't be as easy as they used to be, because, they have to be more cautious and careful.
Yeah. You said a few things I want to expand on. First, you mentioned LTVs. LTVs are lower. Can you first define what LTV is and then explain the impact of that for investment in multifamily or just real estate?
For sure. So LTV is loan to value. So that is the leverage that you're going to get when you're going into a loan, into a deal. For years we were, 80% leverage on multifamily, and now we're more like 65, 70 as the max. There were some deals, if the cash flow was there and the deal made sense, that were maybe even 82, 85% leverage. But now that pullback has happened because values have changed, cap rates are rising, and so now your max loan to value, whether on bridge, is 65 to 70. One thing I can say is a lot of people ask about agency and can you get 80% on agency? And yes, you still can get 80% on agency, but it's even more challenging to do that now because of the interest rate. So even if the property has good in place cash flow, if you're looking at, a 6 or 6.5% interest rate versus a 3.5% interest rate, what we used to see, it can lower your LTV as well.
Yeah, thank you for clarifying that. And so I think that connects to a Washington Post article I saw. It was published a couple months ago, and it read, "Behind the banking crisis, an era of easy money ends." I've heard that phrase, an era of easy money. A lot of people have been dropping that, and in general, like I saw a documentary that was titled that. Can you explain what is meant by the era of easy money, and then maybe connect that to what you said earlier about how lenders are shifting in their due diligence, becoming more strict or more, I guess, diligent, for lack of a better term?
Right, right. Yeah, so right now we're seeing this credit tightening happen, right? So rates are going up, they're trying to get inflation down. They're trying to increase our unemployment, that type of thing. And so when you see that happening, you're always going to have this like, banks are always going to respond because, and it's not just commercial real estate. You've got single family, you've got the people who are being affected, like the working class people who may be at risk of losing their job, which puts them at risk of losing their home. Those are things that the banks have to consider. You've got people that are in a lot of credit card debt, and now the minimum payments on those credit cards are going up because the interest rates are going up, and they may not be able to make those payments. So you're going to see a lot of tightening around, and not just in commercial real estate and single family and credit card lending and bank lending, even development loans. You're going to see that pullback where they say, okay, you're going to have to put more money down, or it won't be as easy as it was before. You're going to have to jump through these hoops, or maybe we can do something based on performance where we'll give you so much now and then give you so much later, depending on how this property performs. So, and that's just in loans, period, not necessarily multifamily or commercial real estate. So, um, prior to the last year, let's say 2020, 2021, 2018, 2017, it was a lot easier to get a higher leverage, lower rate loan. And now, it's not as simple, and the values are also, I talked about cap rates increasing. The values are, declining in some markets, not all markets, but in some markets, the values are declining, which makes it harder to obtain debt. And so, those are, I mean, it's all cyclical, so those are the challenges that we're having. It's not as easy as it was. And I'm typically a very positive person, right? So I veer on the side of positivity. And I know a lot of colleagues that do not. They're all like,
Yeah.
oh, it's just doom and gloom, and this is the end of the world. And a conference I went to, I think I saw you there, at the beginning of the year. And it was like, survive to 2025. Like, I'm like, no, I don't want to do that. But that is like the hashtag of the next year or so, like survive to 2025, because things have changed so much, and they have. It is not as easy, but I have some tips that I share with investors. I know I've shared it with you and your brothers. You know, in the multifamily space, staying in the top 100 MSAs, um, a population over 100,000, doing the A or B class over the C class properties, newer vintage properties, making sure there's sufficient experience. I could go on with a few more, but just those things can make your life a lot easier. But, gone are the days of finding a property in the middle of nowhere and being able to get this high leverage loan with capex included and a 3% interest rate.
Absolutely. I'm really glad you brought those up. I want to give you the opportunity to expand on any of those tips that you give to investors when it comes to identifying the right investment opportunity in this market. I was talking to Brian Burke, who I'm a big fan of. He's a really prominent multifamily investor. And I was talking to him yesterday, and he was saying that Class C properties might not make as much sense in this environment, and particularly maybe have always been risk more involved more risk than people realized. And I heard you mention that you are encouraging investors to pursue A and B class over C class. Do you have anything to add to that sentiment?
Yeah, so the what lenders are looking for right now is the better class property. So from a lending perspective, if my lenders are telling me like we're really not interested in C class properties right now, they're harder to do. We have C class properties that have murders, crime. It's a more challenging asset, class. It's a more challenging asset class in terms of financing it. So when they're pulling in on their risk and they're becoming more risk averse to some, different assets, then that's my word to everybody else. Look, you want to get a better class. It's not a no. It's not, hey, you may find a C class property that you're able to get at such a low cost basis that it makes sense. So I'm not saying it's a no, but it's definitely, hey, if you can do an A and B over a C right now in this climate, that's what you should do. And you got to keep in mind of what's going on with inflation and unemployment. Those are going to be the properties that get hit first historically.
Can you real quick just define what a Class C property is for anyone that might not know?
Yeah, so a Class C property is a property that is, I don't want to say in a lower income neighborhood, but let's just say for a lower income neighborhood, um, it's a market that has a certain median income, and it could vary between the actual market that you're in, but the lower side of the median income. And not a lot of development, not a lot of new things coming to the area, that type of
Hmm.
thing. And you're not seeing as much growth. You're seeing rent growth just because rent does grow typically, right? You're going to see that normal rent growth, or maybe you'll see, and I've seen this too, where it's a C class property and it's the rents are 200 below market, $200 below market. Well, you can come in and you could change the lives of those people living in that property by bringing different amenities, and maybe bringing amenities to the interior of that property, and giving it a little bit of giving those people, I don't want to say a sense of being, but a sense of pride and where they live, right? And you can raise the rents that way. But because those rents were already below market, I feel like you can only push so far,
Yeah.
right? And when we're in an environment where unemployment is on the rise and inflation is on the rise, you cannot push rents on C class properties like that. It's just not going to work. And so I think it will result in more vacancy than it would with, oh, okay, well, than it would with income, right? You're going to push the rents, and then you're going to have more vacancies than you do income coming in. So, and that's what you don't want. But yeah, that is the reasoning behind it, and that's what we classify a C class as. So it's a specific income in a specific area. And I could use examples in Texas, but everybody's not from Texas.
I love it. No, thank you. I appreciate you clarifying that. And I think this all connects to that, just the acquisition of the asset and looking for deals. And my brothers and I, we've been underwriting deals since we got into the industry. And
Yes, you have.
thanks. Yeah, you get a lot of our emails. I'm sorry about that. Kenny's always reaching out to you. But yeah, so like we're always looking, and I mean, it was never easy, to find a deal. But we asked our mentor Mark, who we're he's our mentor, and he was like told us, yes, it's always been hard, but it's been especially more difficult in recent months than normal, and he's been in it longer, so he has that perspective on it. And the question I'm curious to know is, in a previous interview, you mentioned that you thought it was time for a correction, and you were, and so I wanted to kind of expand on that. And my question is a little it's twofold. I'd like to know, why do you think it was time for a correction? But not just that, are we past the correction? Are we in the correction, or is it still coming?
We're in the correction. We're still in it. But it was okay. Anytime things are like too good to be true in real estate, like usually a real estate cycle is 7 years, right? So I think at the 7 year mark, everyone was like, okay, what's going to happen? It was like this expectation, and nothing happened. The market just kept going and kept going. And the rates couldn't stay that low forever, right? And because you all were active during this time, how many times did you put a bid in on a property and you didn't win because that property got 35, 40 bids on it, and it went way over what the whisper price was? And we're all sitting there like, how did that property sell for that? Right? And all that was doing was compressing the cap rates, right? And it's not sustainable. Having rates that low is not sustainable. It could only go so long. And that's just from an economic standpoint. It just is not sustainable. So it was definitely time for a correction. What I do disagree with, and I think a lot of my colleagues would agree with this, is that the speed in which it happened. We were due for a correction, and we were due for this, but not at the speed that it happened. So that's why our everything is just like in a frenzy right now, because it's like, well, wait a minute, that happened way too fast. The rates went up way too fast. Things are changing way too fast, and I think it's the speed in which it happened. But it was definitely due for a correction. When you're looking at properties that are like a two cap in a market that we know is a 5 or 6, we know there is a correction needed there. And unfortunately, what that is going to result in is a lot of over leveraged properties, and a lot of possible short sales or foreclosures. Hopefully it won't be too much, but we saw what happened in Houston, right? Yeah. And so the good thing is this: there's still a lot of liquidity in the market. In 2008, we had no liquidity in the market. There's still liquidity in the market, but I think people are just more just kind of like wait and see what happens, because they're nervous. Everybody is nervous right now. Investors are nervous, brokers are nervous, sellers are nervous, because that's why it's not that much inventory. That was one of the things every broker I talked to, they're like, we don't have enough listings. You know, Sellers are afraid to come to the market right now for a couple of reasons. One, because it's more advantageous for them to hold until the market stabilizes. But two, if they bring it to market, who's to say that you're actually going to get to closing, right? If rates are trending up, we've had deals that were under contract last year over a 90-day period. There were 150 basis point increase while you're under contract. Then you got to go back to the seller and retrade that deal, and they're nervous about that. So until things stabilize, they don't want to bring that property to the market.
And I think a central theme that we've been touching on continuously throughout this conversation is the fact that deals just aren't trading right now. There's that bid ask gap between what sellers want and what buyers are looking to buy the property for. Um, and I do know that you said in the past, like, yeah, you aren't maybe not involved in as many acquisitions, but you're doing a lot of refinances. And I thought that I don't hear a lot of people talk about that, especially in right now in the environment we're in right now. And I would love to know what are some of the complications of surrounding the refinance, and are there certain requirements that investors need to be aware of in order to approach it? And is it more complicated due to the environment we're in right now?
Yeah, so the challenge is that, the bridge that when you did a bridge loan 2 years ago, or when you did a bridge loan before last year, before the rates started to climb, um, when you modeled out your underwriting, I think at the time we were doing like 100 or 200 basis point higher than where the current rates were, which today is still not high enough. So, the challenge with refinancing right now is that a lot of deals are not sizing out. The cash flow is not enough to support such a high interest rate than what we actually modeled out in the beginning. And so either you're having to cash in on a refinance, or you're cash neutral where you're not getting any cash out. And so some investors are choosing to hold out, maybe in hopes that the rates will decline, or hold out and do a sale instead of a refinance. And so the challenge is just the sizing part, like what is the cash flow and how many loan dollars can we get? And if we can't get enough loan dollars to cover the cost and cover the loan payoff, then it's going to be a challenge on the debt side.
In light of all of these changes in the real estate sector in general, but specifically the multifamily space, because I think that that's maybe it's being impacted in a way that maybe single family isn't. I imagine a lot of investors are choosing to, whether that's diversify into single family or just kind of do more single family deals until multifamily picks back up. And so I think that it would be interesting to sort of pivot a little bit the conversation towards that. And if you said you have a background in the single families finance side of things as well, could you maybe expand on the differences between single family financing and multifamily financing?
Yeah, absolutely. The biggest difference, the main difference between single family and multifamily is the recourse aspect. So, usually a multifamily loan will be a non recourse loan. Now, not all of them, of course, but that is the most popular type of financing. And one of the benefits is that, hey, I can get this property and it can be non recourse, which means that I am not personally liable if that property defaults and it goes into foreclosure. There are these clauses, we call them bad boy carve outs, and the lender has these bad boy carve outs that say, okay, you're not personally liable unless we can prove that there was some fraud that took place, or we can prove that you purposely sabotaged something. Then if you just foreclose on a property because the market crashed, the lender takes that back and you're not personally liable for it. Whereas single family is recourse debt, and you are personally liable for it. And so that is the biggest difference between the two. I've always encouraged people to have a diversified portfolio. So I believe in single family. I believe in single family funding your multifamily. So I think you should definitely have single family in your portfolio, and even other commercial asset classes like industrial is a strong asset class right now. Multifamily and storage typically do well in market declines. Those two asset classes perform really well during a downturn. Um, and I can't say that for single family, because usually when a market is going down, people are downsizing. So I don't, depending on where you're invested, you may have a challenge renting that property out to solid tenants. I know Airbnb has been doing well, so maybe that's something that investors could look into, is doing that Airbnb. But yeah, so I believe in having a diversified portfolio. But the biggest difference between single family and multifamily is the non recourse versus recourse aspect. The other difference is the scale, right? As an investor, you go in, you can buy one property at a time, or maybe you can do a few at a time. But the scale is not going to be, 40 units, 120 units, 200 units. So you can scale a lot faster with multifamily real estate versus what you can do in single family real estate. So that's another difference.
Yeah, no, I'm glad you brought that up, the recourse side of things. That's so important, and maybe people aren't aware of that. A lot of them start in single family, but they're not aware of that element of the financing, the difference. To build off that question, I think interest rates right now are, like you meant, you've been discussing it throughout this conversation. It's in every other headline between single family and multifamily interest rates in terms of a correlation. Is there a correlation there? If one rises, what happens to the other?
Yeah, the rates across the board are rising. So most local banks are based off of prime rates, and multifamily rates are based off of the treasury. Everything is going up right now. What we did see in the past few years is that single family real estate and multifamily real estate um, did mimic each other in terms of rate and leverage and that type of thing. Today, um, a single family refinance will probably be around a 6.75 interest rate. Um, a multifamily refinance will be anywhere between 5.5% and 6.5% interest rate. Now, if you did a multifamily refinance at a local bank, that rate is going to be closer to 9%. So, so single family and multifamily agency debt are very similar, But if you're going to take your multifamily property to a local bank, you're going to see a about 200 basis point increase on that rate.
As we look forward to whatever lies ahead for real estate investors, I think you have a really unique perspective on the industry and obviously, from the financing side of things that can offer valuable insight. So, what do you expect? I want to break it down first with multifamily and then single family, but what do you see happening with
Okay.
multifamily financing in the coming months?
So I see that, rates will start to trend down. And I will say this, no matter which side of the spectrum, your political spectrum you're on, we're going into an election year. And from a historical perspective, we're going to see things get better. Rates will come down. And so I think that that's the benefit of where we are in the political cycle. We're going into an election year. I do see that. I do think things will get better. They're gonna have. It's gonna have to get better. But uh, I read an article yesterday that said that the feds are signaling that we'll have two more rate increases before the end of the year. And they don't know what that is. Is that going to be a quarter of a point, a half a point? We don't know what that's going to be. And we don't really know if they're going to actually do it. But I do see volume picking up and I do see rates coming down a little bit towards the end of this year and definitely into 2024. That is what I see. And that is what, based on, articles. I mean, I think I'm on article overload with reading all the information, trying to look at the charts and see, what do I think is going to do. But, but yeah, that's what I think is going to happen. Now, will it come down to where it was? No. I don't think it will, and I don't think it's sustainable anyway, but I do think it will come down a bit because it just went up too fast. You know, it may come down just to go back up a little slower, but it just went up too fast.
Absolutely. And would that outlook change at all when applied to single family financing moving forward? Or would you say something different?
No, I would definitely say I think single family is going to come down to, my heart really goes out to a lot of those first time home buyers. I was just talking to my neighbor today who is a real estate agent, and she was saying that she has a client that has a $300,000 budget. A single mom has a $300,000 budget, and she's been looking for a home for forever.
Mhm.
And, Texas is hot right now. Everybody is still moving here. I don't know if she'll be able to find her a home in an area that has a good school district, anyway, for that price. So my heart goes out to those people when you're paying such a much higher rate. Like if she would have purchased last year, she possibly would have been able to afford, maybe $200,000 more, and she would be in her house by now, if she would have done it at that time. So I feel my heart really goes out to those people who are wanting to be first time home buyers, but the rate is so high and the prices are so high, they can't, what are they going to do?
You touched on your experience at a conference a few months ago, and you said that I've also encountered this among interviews of people I've brought on, or just people I've met in person or spoken to on the phone in the space. That mindset of survive until 2024 or 2025, and I really appreciate your optimism when it comes to not just surviving but thriving in this environment. And so I would love to know, like, what about multifamily and real estate makes you so optimistic? And what advice, besides with the awesome advice you've already given, what advice do you have for people to not only survive but thrive moving forward?
So what makes me optimistic is historical performance of multifamily, right? I've been in real estate for a very long time. And it's cyclical. It's going to go down. It's going to come up. You just got to hold out. You got to hold out. And I've heard this phrase a thousand times. You don't wait and buy real estate. You buy real estate and wait, right? So your investing in real estate is still uh, one of the best investments that you can do, in my opinion. I'm not a an advisor, but that is my opinion. And historically, when we talk about asset classes, multifamily over and over has performed well in down markets, up markets, so I have a lot of faith in multifamily and I think it will do well.
That's awesome. And so to kind of bring it home, this is the final question, but you were at a conference. You said that the general mindset of investors is to not to just survive until 2024, 2025. I mean, you did touch on some advice you give to investors, but what advice do you have for investors who want to thrive in this environment, not just make it survive to live another day?
Yeah, so I always say the first thing you have to do is get your mind together. And if you have time, you have extra time right now, this is the time where you can work on your mind, you can work on your body, and you can overall get yourself together. Read some books. My mom used to say, um, plan your work and work your plan. This is the time when you need to do that. Wake up earlier, do some meditation, do some affirmations and work on yourself internally. Because to me, when everything around you is, you know, not
Mhm.
doing well, you need to keep yourself together mentally, right? So that's the first thing that I would say. And I like to, just stay positive. I wouldn't want to survive to 2025. I want to thrive past 2025. And so, don't give up on going after deals. And that is one thing, the tenacity that you and your brothers have. Like, I know you've probably told people how many deals you've underwritten, but I don't think they really understand how
Appreciate
much tenacity the three of you have. And so I think that is absolutely amazing. And I would not give up on that. I would continue to underwrite deals. I would continue to build those broker relationships. What market are you looking in? Okay, fly to that area, learn that area, go visit some businesses in the area, meet with your brokers in that area, and just stay as active as possible. You want to be on the forefront. So when those deals come in, you'll be the first to see those deals when they do come in. So to me, this is not the time to hit the brakes. This is the time to hit the gas. Go to renocm.com, renocm.com. There you will be able to sign up for my monthly newsletter that goes out with tons of information, current interest rates, whatever the feds are talking about or opinions. I'm going to have it in there for you, including underwriting tips. But my email, phone number, and all that is there as well.